You can identify the head and shoulders pattern in your sleep. You know exactly where the volume profile is heaviest. You can articulate the difference between a simple moving average and an exponential moving average better than the textbook. You have mastered the technical side of the game, so why are you still here? Why does the account still bleed out slowly, not from ignorance, but from self-sabotage? It is because you have been sold the single most dangerous lie in trading, the lie of the high probability setup. When you look at a chart and identify a setup that meets every single one of your criteria, the confluence of indicators, the perfect pullback, the institutional levels, you stop treating it as a probabilistic event. You stop treating it as one outcome in a series of trades. You label it internally. This is a sure thing. That label changes everything. The moment you declare a trade to be high probability, you are no longer trading the market. You are trading your own expectation. The market has a simple truth. Every single trade, no matter how beautiful the setup, has a less than 100% chance of success. It is binary. It either works or it doesn't. Your job is to manage the risk of the failure. But when you attach the high probability label, you implicitly lower your tolerance for failure. You tell yourself that the market must honor your analysis, and this certainty is the poison. Paradoxically, the trades that look the cleanest, the ones that tick every box, are often the most dangerous trades you will ever take. They carry what I call emotional leverage. Emotional leverage is the capital you invest that is not money. It is the investment of your self-worth, your identity as a profitable trader, and your ego. A standard trade might risk 2% of your capital. A high-probability trade risks 2% of your capital, plus 100% of your pride. The market does not care how much work you put into the analysis. It does not care that this was the best setup you had seen all week. When the market moves against your perfect setup, it is not just taking your money. It is telling your ego that you were wrong. And the intermediate trader cannot handle being wrong on a trade they labeled guaranteed. This is why high-probability trades lead to the most catastrophic losses. When they fail, the reaction is not acceptance and moving on. The reaction is panic, disbelief, and immediate revenge. You widen your stop-loss order. You double down. You negotiate with the chart. Why? Because you are desperately trying to protect the emotional leverage you invested. You are trying to prove your initial analysis was right. You are trading with a 0% chance of being wrong factored into your risk management. You believe the only way this trade can fail is if the market is fundamentally broken, or if someone is personally targeting your position. This certainty, this refusal to accept the possibility of failure, is what separates the consistently profitable from the permanently stuck. Until you strip away the emotional leverage and treat every setup, the mediocre ones and the perfect ones, with the exact same clinical detachment, you will continue to pay the hidden cost of certainty. And that cost is devastating because it forces you to trade the reality of the market, not the reality of your self-image. The real question is, are you willing to pay the price to trade a 0% chance of being wrong? And what happens to your system when the market sends you that bill? That bill is paid in the currency of ego. The devastating truth about high-probability trading is not that the trades themselves are bad, but that the expectation of certainty is toxic. You don't need certainty to make money. You need detachment. The moment you demand to know the outcome before the entry, you stop being a trader and start being a desperate gambler seeking validation. This demand for certainty is nothing more than fear wearing a disguise. It's the deep, primal fear of inadequacy, the fear of having your analysis proven irrelevant. And how do we soothe that fear? We build the fortress of confluence. You have your moving average crossover, your volume spike confirmation, the retest of the previous week's high, 5, 6, 7 reasons why this setup must work. You tell yourself you are being diligent, meticulous. But look closer. Are you stacking confirmations to increase your objective edge? Or are you stacking them to decrease your subjective anxiety? It is almost always the latter. You are not building a better trade. You are building a psychological shield against the possibility of being wrong. This is the confluence trap. It feels safe, it feels professional, but it has shifted your focus entirely. The trade starts as a valid setup, a clinical, statistical event. But the moment you click the button, something dangerous happens in your brain. It transforms from a high probability setup into a personal promise. It shifts from, "This aligns with my system's edge," to, "This must work because I found 5 reasons for it." That is the exact point where objective analysis dies and the ego begins to run the show. The market doesn't care about your 5 reasons. It doesn't care about your hours of screen time. It only cares about order flow. But your ego, now fully invested, demands a return on its intellectual capital. This ownership bias is the most insidious trap. If the market immediately turns against you, if the setup invalidates itself within minutes, why is it so hard to simply close the position? Why do you hold on and rationalize the drawdown? Because reversing course, admitting the trade is flawed, now feels like admitting personal failure. Your analysis becomes fused with your identity. To honor the stop-loss is to concede that the hours you spent stacking those 5 confirmations were wasted, that your judgment was flawed. The market is giving you cheap, immediate feedback, but your ego refuses to accept the gift. It sees the stop-loss not as risk management, but as a public declaration of your incompetence. So you hold. You wait. You pray for the validation that your pride demands. This is the psychological tax the market charges for seeking certainty. And what is the practical consequence of trading with 100% certainty? You size inappropriately. You look at that perfect confluence, that fortress of reasons, and you think, "This one is different. I can double my risk here. This trade cannot fail." The belief in certainty is the direct path to violating your maximum risk rules. It is the reason you disable your hard stop loss. It is the reason you manually drag the stop further away, just waiting for the inevitable reversal that your ego promised you. You have now moved from trading a statistically valid strategy to betting your entire mental capital on a single, perfect outcome. And when you commit to that level of certainty, you have already guaranteed one thing. You will refuse to honor the cost of being wrong. You will refuse to take the small loss because the small loss invalidates the big ego. The question then becomes, if certainty is the poison, how do we begin to trade with radical detached probability? And how do we calculate risk when we have convinced ourselves the risk is 0? The calculation of risk doesn't change, but your perception of its necessity dissolves the moment you hit the maximum confidence button. You have found the perfect setup. The convergence of indicators is flawless. The fundamental news aligns exactly with the technical structure. You have done the work, and the market is about to reward you. In that moment, the trade ceases to be a statistical event. It becomes a guaranteed outcome. And because you are human, guaranteed outcomes demand maximum leverage. Why would you risk 1% when you absolutely know, this is a 5% move? To use anything less than maximum size feels like leaving money on the table, a financial inefficiency that mocks your superior analysis. This is the moment you stop calculating risk and start calculating potential profit, allowing the siren song of fear of missing out to dictate your position sizing. You have now injected emotional leverage into the trade. You are borrowing confidence against your future sanity. Then the market does what the market always does. It tests your conviction. The price moves against you. Not significantly, not yet, but enough to trigger a brief, unwelcome flicker of doubt. The price approaches the point where you placed your stop loss. This is where the stop loss transforms from a mathematical safety boundary into a personal affront. It is a physical declaration on your screen that your analysis was wrong, that your certainty was flawed, and that your ego must absorb a painful correction. The market is insulting you. It is rejecting the hours of screen time, the backtesting, the sleepless nights you invested in developing this edge. The internal dialogue begins instantly. It's just noise. The big players are shaking out the weak hands. This is the last dip before the massive run. You refuse to accept the insult. You refuse to let this tiny, insignificant countermove invalidate your expertise. So what do? You negotiate. You move the stop loss. It is the oldest, most destructive violation in trading. You are not moving the stop loss to a safer, more logical place. You are moving it to a place where it cannot hurt your ego yet. You are trading capital for time, hoping that the pain will resolve itself. You are giving the market more rope to hang you. And if the market continues its relentless push against your position, the negotiation becomes desperation. You look at the price, now significantly below your entry, and think, it's so cheap now. This is an even better value. You double down. You add size to a losing position. This is the ultimate act of emotional leverage, staking everything on the delusional belief that if the original high-probability trade fails, the exponentially riskier rescue trade will succeed. You must understand this realization. The probability of the trade succeeding might have been high, perhaps 70%, but the moment you oversize that position based on your conviction, the probability of catastrophic emotional damage hits 100%. It is a mathematical certainty that the larger the position, the more emotionally invested you become, and the less capable you are of executing objective risk management. The loss is no longer just a financial deduction. It is an existential threat to your identity as a profitable trader. It proves that your best work, your most certain setup, was the instrument of your downfall. The true test of discipline is not executing the easy textbook trades that work immediately. Discipline is tested on the best setup that fails. It is tested when the market laughs at your conviction and drags your oversized position toward the abyss. That is the moment where the decision to move the stop loss, or to honor it, defines the trajectory of your entire career. You sought certainty to eliminate risk, but you only succeeded in creating the perfect trap for your own psychology. The paradox is that the very trades you felt most confident about were the ones that required the most rigorous, detached, and ruthless adherence to your protective boundaries. We must redefine what winning truly means in this environment. If the best setups are the most dangerous, we must learn to treat every single entry, even the perfect ones, as statistically random events that require identical, unwavering risk parameters. The question is, how do you enforce that level of detachment when the charts are screaming, "Go all in"? The chart isn't screaming, your ego is. That voice, the one that tells you this setup is the one that will finally prove you belong here. That is the saboteur. It's the part of you that believes being wrong about a trade means you are fundamentally incompetent. It conflates the probabilistic outcome of a single event with the entirety of your self-worth. When a trade goes against you, it's not just a monetary loss, it's a personal insult. This is the hidden stage of trading psychology, the moment your identity enters the equation. Think back to your worst trading day. It didn't start with a massive, catastrophic loss. It started with a small, irritating loss on a high-probability setup you were certain about. That certainty was the trap. When the market rejected your perceived brilliance, what did you do? You didn't adjust risk. You doubled down. You escalated the position size immediately, not because the system mandated it, but because you needed to prove the market wrong. You needed to reclaim the competence that fleeting moment of red numbers had stolen from you. This is revenge trading, and it is rarely driven by simple greed, but by wounded pride. It is a desperate attempt to restore your internal balance sheet of self-worth. The refusal to accept that you can be right about the analysis and still be wrong about the outcome is the most dangerous bias you face. The irony is that the aggression, the immediate need to chase the loss, only guarantees a deeper emotional wound. You trade poorly, you lose more, and the shame sets in. Shame tells you that you are fundamentally flawed. To cope with that feeling, you become aggressive again, seeking immediate validation through the next trade. It becomes a relentless, self-reinforcing loop of emotional pain. Have you ever felt that intense burning need to just be done with the market after a series of losses, only to find yourself back at the keyboard 10 minutes later, desperately looking for the next entry? That is the ego fighting for its life, mistaking the randomness of the price action for a judgment on your character. The market doesn't care about your intelligence. It doesn't recognize your degree, your years of screen time, or the hours you spent backtesting the perfect setup. It simply processes orders. The true enemy, the one destroying your account and your peace of mind, is your refusal to accept that the outcome of any single trade is statistically random. We, as human beings, are biologically wired to seek patterns and exert control. When the market throws a curveball at your perfect setup, it attacks that fundamental protective need for control. You didn't lose because your edge is broken. You lost because the probability distribution played out its role. Your job is not to predict the future. Your job is to manage the exposure to that uncertainty. Detachment is not apathy. It is the profound realization that you can execute a phenomenal setup flawlessly, follow your rules perfectly, and still face a loss. And that loss must mean absolutely nothing to your identity. Your self-worth must be completely decoupled from your profit and loss. You must learn to trade the system, not the prediction. The moment you believe you have a crystal ball, the market will shatter it. The only way to survive the high-probability trade is to remove the certainty from the equation. The only way to execute your edge consistently is to treat the phenomenal setup, the one that feels like a guaranteed winner, with the same cold, mechanical indifference as you would treat a simple coin flip. This is the ultimate paradox of professional trading. You spend weeks hunting for the best possible edge, the highest probability entry, only to realize that mastering the execution requires you to treat that phenomenal setup like it's 50-50. Why? Because until you achieve that radical acceptance of randomness, your risk parameters will always betray you. They will always stretch just enough for the internal saboteur to take control. They will always stretch just enough for the internal saboteur to take control. This is where we introduce the concept of emotional arithmetic. It is not just about calculating dollars and cents. It is about calculating the emotional cost of failure before you ever click the button. What is the true price of this stop loss? Is it just the 1% of capital, or is it the subsequent 3 days of mental anguish, the self-doubt, the urge to revenge trade? If you cannot truly calculate and accept that emotional debit before the trade starts, you have already over-leveraged the one thing that truly matters: your mental capital. The mental solution is deceptively simple. Calibrate your expectation. Every setup, no matter how textbook, no matter how many confirmations you have stacked, must be mentally downgraded to 50% probability. This is not pessimism, it is professional risk management. It forces you to ask, if this fantastic setup fails, will I be okay? If the answer is anything other than a trivial, instantaneous, yes, absolutely, then your position size is wrong or your entry criteria are polluted by hope. Hope is the single greatest enemy of execution. It is the silent leverage. The paradox emerges when the trade goes right. When you execute a high-probability trade, your expectation is that it will run flawlessly to your predetermined take profit. But the market rarely grants smooth sailing. It tests you, it pulls back. It enters a vicious consolidation phase, often wiping out half your paper gains, just to see if you are truly committed to the system, or just committed to the feeling of being right. If your emotional investment in the setup was high, if you were certain it would work, then the moment the trade goes against you, even temporarily, the fear of losing the paper profit becomes unbearable. You bail out early, securing a small win, only to watch the trade hit your original target moments later. You traded perfectly, yet you failed in execution because your expectation was rigid. This is the power of trivial emotional commitment. When you truly accept the 50% chance of failure, the drawdown becomes just noise. It is just the market doing what markets do. You maintain the patience required to hold for the full distribution of the edge. The higher the technical probability of your setup, the smaller your position size should feel emotionally. That is the true calibration. We must differentiate between confidence and certainty. Confidence is the measured belief in your proven system's edge over a large sample size. It is statistical. Certainty is the reckless emotional conviction that this specific trade cannot fail. Certainty is the feeling that pushes you to move your stop loss, to add to a losing position, or to take profits too early because you cannot bear the thought of being wrong. Certainty is a psychological flaw dressed up as competence. It is the ego demanding immediate gratification and validation. Confidence sustains you through the inevitable losing streaks. Certainty destroys you on the single perfect setup. Certainty is the market's toll booth. It charges you your consistency, and it accepts only ego as payment. If you allow certainty to dictate your actions, you will find that the highest probability setups, the ones you painstakingly waited for, become your most emotionally damaging losses. But how do we truly decouple the technical signal from the internal, self-sabotaging need to be right? How do we stop confusing statistical edge with personal infallibility? That requires a deeper look into the architecture of your emotional threshold. The emotional threshold breaks when expectation meets statistical reality. We need to implement a concept known as radical acceptance. This is not passive resignation, it is active, disciplined surrender. It is the profound understanding that you can execute the entry perfectly, manage the risk flawlessly, identify the setup with clinical precision, and still lose. That specific outcome is not only acceptable, but expected within a statistical framework. The market is not fair, and it is certainly not obligated to reward your effort. It is a random variable generator overlaid with human behavior. You cannot control the market. You can only control your response to the market. This truth is the impenetrable wall that most intermediate traders hit. They fight the loss, they argue with the chart, believing their sophisticated analysis somehow earned them an inalienable right to a profit. But the market does not grade on effort. Radical acceptance means accepting the inherent randomness woven into the fabric of price action. It means internalizing that the highest probability trade still holds a significant chance of failure, a 30 or 40% chance, and that percentage does not care how much time you spent backtesting or how sound your fundamental thesis is. When you cling to the desperate need for a specific outcome on a single trade, you are trading fantasy, not statistics. And fantasy always results in emotional chaos. Surrender the need to be right. Surrender the expectation of reward on this specific trade. This is the hardest psychological hurdle because it feels counterintuitive. Most traders confuse non-attachment with apathy. It is not apathy. It is the highest form of disciplined objectivity. You are trading a methodology, not a prediction. This acceptance frees up the mental bandwidth required for the defining characteristic of high-probability trading: deep patience. And I don't mean just patience waiting for the entry, but patience required inside the trade, especially when you are currently in profit. High-probability trades often require long holding periods to realize their full statistical potential. So why do intermediate traders fail to hold winners? Because the emotional relief of locking in a small profit, stopping the anxiety of uncertainty, outweighs the cold, hard, statistical financial goal. We take the small gain because it provides immediate emotional validation. It confirms we were right, even if it leaves 80% of the potential profit and loss on the table. This is the ego demanding a trophy now, rather than the professional demanding the maximum statistical yield later. When you exit early, you are not protecting capital. You are protecting your ego from the possibility of the market turning around and taking back your paper gains. You are substituting emotional comfort for tactical execution. The professional trader understands that the trade is judged on one metric and one metric only: adherence to the process. Did I identify the setup correctly? Did I size the position according to the risk management rules? Did I hold until the defined take profit or the defined stop loss was hit? If the answers are yes, the trade was successful, regardless of whether it was a winner or a loser. The outcome is merely data input for the next cycle. Your profit and loss statement is merely a lagging indicator of your discipline. Stop tying your self-worth to the daily fluctuation of your equity curve. The market is not judging you. It is simply processing orders. The moment you achieve this non-attachment, you stop seeking the emotional high of the win and start seeking the quiet certainty of the process. This is the foundational shift, the step required to stop sabotaging your best setups. but it is not the final one. To truly transition from the intermediate stage to true expertise, to move beyond the psychological traps entirely, you must perform one last terrifying operation. You must change who you fundamentally believe yourself to be. You must execute the final identity shift. The true secret of high-probability trading is this: they are not rewards for patience. They are stress tests. They are precision tools designed by the market itself to expose the hidden gaps in your discipline. Think about it. Why do your best setups, the ones with the highest statistical edge, often result in the worst emotional blowouts? Because the potential reward is so clear, the pressure to not mess it up becomes suffocating. That pressure is the test. It forces your underlying relationship with control and money to the surface. The market doesn't care about your moving averages or your Fibonacci retracements. It only cares about your execution. The intermediate trader spends 90% of their energy searching for the perfect 20% setup. The expert spends 90% of their energy perfecting the execution of the imperfect 80%. Stop trying to find the perfect trade. Start becoming the perfect executor. That is the critical rewiring. The market is not a puzzle to be solved. It is a mirror. What you see reflected on your screens is not the price of a stock or a currency pair. It is your internal calibration. If you see chaotic price action, it is because your internal relationship with risk is chaotic. If you are constantly chasing, it is because you fundamentally believe you are missing out on something essential in your life. The market simply reflects your deepest fears about scarcity and control. You cannot control the 70 or 80% probability of the setup. That belongs to the collective consensus, the algorithm, and the random walk. But you can control the 100% probability of your discipline. That is the only probability that matters. That is the only edge you truly own. Your goal is not to eliminate risk. Your goal is to eliminate emotional friction. Mastery is not about making the trade that wins 80% of the time. Mastery is about accepting the 20% loss, the inevitable statistical loss, with zero emotional friction. Accepting it the moment the stop loss is triggered, without complaint, without hesitation, and without the need for immediate revenge. That acceptance is the final surrender that paradoxically grants you ultimate control. But how do you build a system that can withstand that level of emotional shock? That requires us to redefine the very concept of risk management itself. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.